You can say that my great skill has been avoiding bad luck, but that isn't a skill, that's luck, or bad activities. And you realize the game isn't quite as easy as it looks. But getting a decent result actually is.
The recent Berkshire Hathaway Shareholder meeting was very informative. Warren Buffett has always had a lot of investing advice to share, and in this video, I'd like to explore some of the advice that he gave. To start us off, let's look at what he had to say when he was asked how he would go about investing with the aim of getting a 50% annual return if he had to start over in today's environment as a 20-year-old American with less than $1 million. Side note, this is something he previously said that he could do. So for all the skeptics, doubters, and faithful followers alike, and of course the 20-year-olds, listen up.
I don't know what the equivalent of Moody's manuals or anything would be now, but I would try and know everything about everything small, and I would find something, and with $1 million you could earn 50% a year. But you have to be in love with the subject. You can't just be in love with the money. You really got to just find it like essentially like, people find other things in other fields because they just love looking for it. A biologist looks for something because they want to find something. I've had the luck of meeting a lot of people that are unbelievably smart in their own arena and do some unbelievably dumb things in other areas. So all I know is the human brain is complicated, but it does its best when you find out what your brain is really suited for, and then you just pound the hell out from that point. And that's what I would be doing if I had a small amount of money and I wanted to make 50% a year, but I also wanted to just play the game. And you can't do it if you don't find the game of interest, whether it's bridge or whatever it may be, chess, or in this case, finding securities that are undervalued.
I also don't know what the equivalent of the Moody's manuals is today, but we live in an information age, so that shouldn't be a problem. The first thing he talks about that is worth noting is finding something small with great upside. This is important because that company will have bigger growth potential than a well-established company that has been doing well for a while. Second, it must be something you are really interested in. He pretty much talked about what he likes to call the circle of competence, without really calling it that. When he speaks about being smart in a certain arena, he means that you must know your strengths and focus on using them to your advantage. If you understand a certain industry, and you can easily identify a company that has a certain advantage and opportunity to grow, then that's where you should focus. Not just on making a lot of money, because chances are you might not make much in an industry that you don't understand. Plain and simple, right? The second lesson is not just for CEOs as the answer would suggest, but even for investors looking to improve their skills such as you and I. Here's what he had to say.
As the world gets more sophisticated, complicated, and intertwined, more can go wrong. And there's no sense going through here and exploring the possibilities of the different things that could happen. But we do want to be able to act when it happens. And I think the chief executive should be somebody that can weigh buying businesses, buying stocks, doing all kinds of things that might come up at a time when nobody else is willing to move. It wasn't that people didn't have money in 2008. It's that they were paralyzed. And we did have the advantage of having some capital and a willingness an eagerness even to act. And if you look back, as we did a few meetings ago, as the top 20 companies in the world at 10-year intervals, you realize the game isn't quite as easy as it looks. But getting a decent result actually should be reasonably easy if you just don't get talked out of doing what hasn't worked in the past, and don't get carried away with fads, and don't listen to people who have different interests.
I like how he speaks on the ever-changing world with all of its complications, how it would serve you best to stick to what you know and not chase the latest trends in investing. He also spoke of the importance of being able to identify and act on opportunities that present themselves in times of trouble. This goes back to his popular advice to be greedy when others are fearful and fearful when others are greedy. It's usually in the midst of trouble that some of the greatest opportunities and successes are found. Someone will find the solution to a problem and sell it, thus helping them make a fortune. That is what businesses exist for, and that is what we should look for in the businesses we choose to invest in. He also talked about not allowing yourself to be talked out of acting on opportunities that you have identified. You cannot listen to everyone and still be right, you know? Moving on, I think it's pretty common for us to look at companies that are doing well and feel like we've missed out, right? What did Warren have to say about that?
Charlie and I would, we missed a lot of things. And what we really regretted was missing something that turned out to be very big. We never worried about missing something that we didn't understand. I mean, why should we be able to, predict the future of every business any more than we can predict, what wheat yields are likely to be in Illinois next year? Well, not wheat in Illinois, wheat in Kansas, but corn in Illinois.
Okay, that was straight to the point. If you don't understand it, then you didn't really miss out, because you shouldn't be buying anyway. This goes back to the earlier point about knowing your circle of competence and sticking to it. If you don't understand the business, then what exactly are you investing in? And again, you can't predict how stocks are going to perform, as he has made very clear. So if you see a stock do well and you don't have any skin in the game, but you're still doing well with what you invested in, that should be enough. And since you can't predict how stocks will perform, how do you know when to enter or exit a position?
Well, there are various reasons for exiting positions. One is if you need the money, but that doesn't happen very often with us. But it used to happen on every decision I made when I started, although I actually started in 1942, if you just talk about buying stocks. But in any event, the decision process is really quite interesting in a certain way, because people have speculated on how I've decided to really put a lot of money into Apple. And for a reason, I can't. One thing that Charlie and I both learned a lot about was consumer behavior. And See's Candy was also a study of consumer behavior. We didn't know how to make candy. There were all kinds of things we didn't know. But we've learned more about consumer behavior as we go along. And that sort of background, in a very general way, led up to the study of consumer behavior in terms of Apple's products. And in that case...
So here he talks about exiting a position when you need the money, which wasn't really the case with his sale of Apple stock. It was more of a calculated move. This, however, does not mean that you must invest the money you're going to need in 3 months' time. Chances are, if you do that, you might end up losing the money. He also talked about human behavior being a factor in deciding to buy Apple in the first place, because the brand has so much power, it actually influences behavior. He understands that more than just the product, Apple is selling a feeling that is very closely associated to its products. This has a huge influence on people's behavior towards the product, and is something he learned over time while investing in other businesses like See's Candy. So here's a question for you. What do you think makes Warren Buffett one of the most successful investors ever? His answer is one that is very surprising to the average person, but it makes a lot of sense. Here's what he had to say.
You can say that my great skill has been avoiding bad luck, but that isn't a skill, that's luck, or bad activities. And then to get to be, I would not have been if you'd taken my high school class and you say, a couple of you are going to live to be 90, men are going to live to be 93, I would not have been a heavy favorite, I can tell you that. And I wouldn't have bet on myself. But you just, now you should make the most of your luck when you get it. And sometimes I've done that and sometimes I haven't.
Can you believe that? The greatest investor in our time saying that he has just been lucky enough to be able to make the kinds of returns that he has made. Luck is definitely a very critical part of the equation. You don't have control over every situation you find yourself in, but luck being on your side makes it all come together. Another thing that he mentioned was longevity. Having started investing from a very young age, he had all the time to learn and grow, but at the same time, his investments have had plenty of time to compound and to pay him back. For example, he likes speaking about Coca-Cola and American Express, which he has held for quite a while and from which he has benefited a lot. The amount of money he makes in dividends from those two companies alone is insanely huge. So essentially, luck to a certain degree depends on your preparation and action. You have to make the most of the opportunities that present themselves to you. Okay, so that's all well and good, but where does one even start? Many people find themselves in a state of paralysis by analysis. What advice does Warren Buffett have for them?
But finally, I picked up a copy of The Intelligent Investor in Lincoln, and there was a few sentences in there that said much more eloquently than I can say it. But if you look at stocks as a business and treat the market as something that doesn't tell you, isn't there to instruct you, but it's there to serve you, you'll do a lot better over time than if you try to take charts and listen to people talk about moving averages and look at the Fed pronouncements and all of that sort of thing. And so that made a lot of sense to me then. And the way I've been allowed to deploy it, Charlie and I talked about this, of course, constantly. It's changed over the years as the amount of capital we have and has changed and all of that. But the basic principle was laid out by Ben Graham in that book, which I picked up for a couple of dollars, and which basically said to me, you've been wasting your time now, but maybe you can use what you've learned or been reading about and put it to better use. And then Charlie came along and told me how to put it to even better use. And that's sort of the story of why we own American Express, which is a wonderful business. We own Coca-Cola, which is a wonderful business. And we own Apple, which is an even better business.
You see, just as I said earlier, Coca-Cola and American Express are just his favorites. Anyway, one lesson we can take from this is that how you view your stocks and the stock market is a very big factor in how you go about your investments. Stocks represent companies and the market is there to serve you. What Warren Buffett is telling us in essence is to simplify. You don't have to complicate your investments. The simpler they are, the better. You need to learn by action. If you wait until you know everything, then you will wait forever. Warren's experience was the same. He learned and became better as he was doing it and seeing the results of his efforts. And you should do the same. So start today. What are you waiting for? This last piece of advice is very important, as it is often overlooked due to human nature. What is it? Well, let's find out.
There are certain things that just take a certain amount of time. My daughter hates it when I use this example, but it's really true that you can't create a baby in 1 month by getting 9 women pregnant. I mean, you may want a baby, but so there are certain laws of nature that you have to work with.
Very funny analogy, but it holds a very important truth, especially when it comes to investing. In order to see the kinds of returns the likes of Warren Buffett see, you have to exercise a lot of patience. Compounding takes time. As the saying goes, time in the market beats timing the market. If you are looking to make a quick buck, then investing in the stock market is probably not your best bet. Be patient. Learn as much as you can, stay invested, and remember that it takes 9 months to have a baby. These are some of the lessons that we can learn from Warren Buffett when it comes to becoming a successful investor. I hope that you found value in this video. If you did, then please show some appreciation by hitting that like button. If you'd like to see more content like this, then subscribe to the channel and turn on your notifications so you can always learn lessons that help you make compound interest your best interest. Thanks for watching. Here's another video that you might enjoy. Click on it and I'll see you there.